If you needed further evidence that the Federal Reserve's tightening and interest rate policy is having a dramatic effect on the economy, I present to you Goldman Sachs Q4 earnings today. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Goldman Sachs after the company reported their Q4 earnings this morning. Now, over the last year, stock is down just 4.3%. I say just because, man, you look at your portfolio, mine included, it's down a heck of a lot more than that. Now, over the last 6 months, though, stock's been in rally mode. Like a lot of the bank stocks, like a lot of stocks in general, up 29%. It looks like we are going to see a pullback. I say it looks like. I'm recording this about 5 minutes before the opening of the market. Looks like this one's pulling back by about 3%. But when you come over here and look at this from a technical perspective, you are going to see this is a natural spot to where Goldman Sachs might take a little bit of breather from a stock perspective. Now, the earnings came in, the Q4 earnings came in. We had about, we'll call that $10.6 billion worth of revenue. That was a decline of 16% year over year, and it missed expectations by about $320 million. They missed on the EPS and the earnings side as well. We'll talk about that as we move through these results. Now, the expectations was a number much closer to about $11 billion. So Wall Street was expecting a decline. So the decline in revenue is not something that Wall Street wasn't anticipating. But what Wall Street is anticipating is we go back to kind of flattish to lower single-digit growth for the next couple of quarters, and then have a dramatic increase towards the back half of this year. Might support some theses out there that the first half of the year will be somewhat difficult, and then the back half will get a little bit better from a revenue perspective. And then also from an earnings side, you're going to go negative on that EPS growth. And then after, we'll talk about some of the cost controls this company is going to have to do. It might get a little bit better towards the back half of the year. Goldman Sachs consumer transaction banking business lost billions of dollars over the past 3 years as consumers got those Apple credit cards and bought a phone and then decided not to pay it back. The company also closed, it had this Marcus bank account and savings account. They kind of shuttered that business as well. But the company is expanding its ties to Apple to continue to grow that consumer banking business. So while Goldman Sachs is taking it on the chin as they're losing billions of dollars in the unit over the past couple of years, I believe they're just looking at it as kind of a longer term investment. They're going to continue to grow that with Apple and see where things goes. Goldman Sachs is going to join Amazon, Meta, Twitter, and the rest of the tech community and lay off about 3,200 workers. This was as of last week. We'll show you when we get over to the financials. This company does need to trim some costs. Now, Goldman Sachs seeks to buy discounted crypto firms after that FTX collapse. So they are taking that as an opportunity as well. Obviously, you had that massive FTX collapse that is being worked through bankruptcy, essentially, and you have that whole industry in flux. But look, you look at the price of crypto right now, it's still it's held up considerably well, considering all the things that have been going on the exchange side. Goldman Sachs may be going to step in there and gain a leadership role there. Now, come over here to the financials. You are going to see evidence that the Federal Reserve's tightening is absolutely working. I know everybody is just focused on looking at used car prices and maybe the price of rent or something like that. Goldman Sachs results are going to show you it's going to get a heck of a lot worse. And I'm not sitting here saying that the Federal Reserve needs to stop hiking rates and then drop them back down to zero. What I'm saying is they could hit the pause button right now, and you would still have a dramatic effect on these earnings. What I am worried about, and I'm not necessarily worried or losing sleep about this, but what's going to happen is if they continue to hike rates, they are going to over-tighten, just like they under-tightened or they were slow to tighten rates or tightened financial conditions. They were slow to that. And if they are slow to hit the pause button or say, hey, let's see the impact of this for maybe a couple of quarters or maybe even a full year, well, it's going to continue the boom and bust cycles that we've experienced over the last really several decades with the Federal Reserve just tightening too much, not tightening enough, and it just creates these boom and bust cycles. And it's great. Look, if you have the stomach for it, it's fantastic, but it's terrible if you're close to retirement or you're not actively managing your portfolio. Now, come over here to Goldman Sachs, and you're going to see evidence of this. Equity underwriting down 82% 82% year over year. Guys, when you see a business down 82%, it basically means it went away. It was $1 billion business this time last year. Equity underwriting is IPOs, any types of equity fundraising. This is showing you, again, I'm not breaking any news here, that nobody is going public. And when companies don't go public, they don't buy office space, they don't buy office chairs, they don't get cleaning crews, their employees don't get new apartments, all those types of things. Again, this is macroeconomics. So when you don't have equity underwriting, and look, to go from $1 billion at one of the biggest equity underwriting businesses in the world, you go from $1 billion last year all the way down to $183 million. I mean, that's a rounding error. It's nothing. Might as well be zero. That is a dramatic drop in this business. Okay, just quarter over quarter, you're down 25%. I mean, it's just dramatic. Debt underwriting. So companies taking on debt to buy equipment, start a new business, just run the business. That is down 70% year over year, from 947 all the way down to 282. You look across the board at the global banking markets, that is down 14% year over year, 14% quarter over quarter. You come down here to asset and wealth management. You think you had a bad year investing in equities? Well, take a look at Goldman Sachs, down 80% year over year, from a $1.5 billion business down again to essentially a rounding error at about $287 million. Quarter over quarter, you're down 60%. I mean, these are gigantic numbers. Net revenues in their asset and wealth management business, 27% year over year, 12% quarter over quarter. Again, if the Federal Reserve wants to keep raising interest rates, a quarter here, half point here, this is going to continue. You're going to drive these businesses down to basically zero. And you see over the last year, we talked about it at the top, your total net revenues down 16% year over year, 12% quarter over quarter. This is why the Federal Reserve, if they were smart, they would hit the pause button and just let these things kind of trickle through the economy. It wouldn't slam inflation back down to their 2% target overnight, but it would create a kind of a softer landing. If they continue to hike, that is actually going to create the hard landing that they supposedly, which I don't think they supposedly want to do that. I actually think they want to crash this thing. They want to make their buddies even richer, as if you slam asset prices back down to the floor, the only people that are going to be surviving and able to buy them up are the wealthy elites in society. Now, come over here to the expense side over the company. You see, again, revenues down 21% year over year, 14% year over year. Unfortunately, your operating expenses went up 11% year over year and 5% quarter over quarter. That is why you are going to have to cut some jobs over at Goldman Sachs. So again, playing right into the hands of the Federal Reserve. You see a tightening of financial conditions. Businesses aren't going public. Nobody is taking on debt. Asset prices and equity values have just fallen to the floor. Even debt investments have done incredibly poorly. If you were all in bonds last year, you had a losing year as well. Everything is getting slammed to the floor. And then so what do you have to do? You got to start laying people off. That is apparently what the Federal Reserve wants to do as well. So what we are seeing over at Goldman Sachs is just the perfect playbook, perfect storm, and the Federal Reserve's playbook playing out basically perfectly. Now, speaking of perfect, we've got a 20-year uptrend going on over at Goldman Sachs. Now, it's volatile, top to bottom on this one. You've got a pretty wide range, okay? You've got you've got 100% range with this type of thing. This is why investing in individual stocks is not easy. This is why most people tap out of investing in individual stocks, because they can't stand being up 100% in a stock like Goldman Sachs, and it really just going to the top of a technical range and then correcting back down to the bottom like 100%. But this is literally what dreams are made of. I mean, this stock is very volatile. It is sitting at the top of a range right now. You would absolutely expect this stock to kind of give this back over the next maybe several quarters or so. As it does, that creates buying opportunities really all the way down here. Kind of a medium-term trajectory to the pullback on Goldman Sachs would take you I'll just call it south of 300. South of 300 on this one would be where I would start getting interested in adding to a position. I have a very small position in this. By very small, I think I have like 2 shares of this stock that I bought back sometime during the Trump administration. He was hiring a bunch of people from Goldman Sachs, so I figured it'd be good for the stock. I don't think I'm up a ton of it, but it's something that I'm going to hold for the longer term. That was Goldman Sachs. As you see, stock's down about 2.25% to start the day, but over the last 6 months, it has been rallying, and over the last year, this one's actually held up relatively nicely. We are seeing strong evidence that the Federal Reserve is going to have to hit the pause button, and if they don't, they're going to create wide swings in equities, and that is to the advantage of people that can stomach those large swings. If you can't, you probably should have been on the sidelines since last year. Hopefully, you guys enjoyed today's video. We'll be back again soon as earnings season is underway now. Hopefully, you guys have a great day out there. Good luck with your investments.